Welcome to Talk Tickers, the show dedicated to cutting through the noise and delivering precise insights from the latest earnings calls.
Today, we're taking a deep dive into the Q2 2025 earnings call of AerCap, ticker AER. They're a huge player in global aircraft leasing.
Yeah, and we're focusing on their recent call, July 30th. It's really fascinating, actually. You see these seemingly strong fundamentals.
That's right.
But then the market reaction, well, it tells a slightly different story, or at least a more cautious one.
Exactly. That's the puzzle we want to unpack for you today, this divergence between strong reported results and that immediate market hesitation.
Okay, so let's kick off with the headline numbers. Give us the snapshot.
Right. So AerCap reported GAAP EPS of $7.09, and adjusted EPS came in at $2.83.
Both beating consensus estimates pretty handily, right?
Oh, yeah. The adjusted EPS beat by a solid 0.30 cents. But here's the first twist. Revenue and other income, they actually landed slightly below expectations, $1,887 million.
Which was down year over year, too.
That's right, down 4% from $1,958 million last year. So a strong bottom line beat, but a slight miss on the top line.
Interesting. And operationally, how did things look? Because those numbers sounded pretty good.
Operationally, the picture was robust. I mean, a 99% utilization rate.
Wow.
And a 97% lease extension rate. Plus, operating cash flow looks strong, too, $1.3 billion.
Okay, so 99% utilization, strong cash flow. Yet, despite these, mostly positive figures, the stock dipped intraday.
It did. A modest negative sentiment right after the call.
That's exactly the contradiction we're talking about. It's why this call is so interesting to dissect.
Okay, let's unpack this a bit more.
Right, let's dig in. That standout financial item, the one that really jumps off the page, was that GAAP net income, a record $1.3 billion.
Yeah, it was huge. And that record GAAP EPS of $7.09, well, it includes a really substantial net recovery.
From the Russia situation.
Exactly. $973 million, or about 5.78 cents per share, came from that favorable London court judgment related to assets lost over there.
So a massive one-off gain, but did it have other impacts?
It absolutely did. It wasn't just earnings. It helped drive their adjusted debt-to-equity ratio down.
Oh, right.
Yeah, down 2.2 to 1. It was 2.4 to 1 last quarter. So a healthier balance sheet coming out of it. For you listening, that's a significant de-risking.
Okay, so a big legal win strengthening the books. Beyond that, though, management sounded pretty optimistic, didn't they? They raised guidance quite a bit.
They did. Full year 2025 adjusted EPS guidance is now approximately $11.60.
Which is a huge jump from, what was it, $8.50 to $9.50 before.
Exactly. A big leap. Now, it's important to note, this revised guidance does include about a $1.10 per share gain from asset sales they already booked in the first half.
Okay.
But crucially, they said they're assuming no further gains from sales in the second half of the year.
So it's not just the one-offs driving that optimism. They seem confident in the core business, too.
That's the message, yes. It signals real confidence in their underlying business trajectory and, the demand environment.
Speaking of the business, they also highlighted some strategic moves. What caught your eye there?
Well, the new engine leasing joint venture with Air France-KLM really stands out, focusing on LAP engines.
How does that work? What's the benefit?
It seems mutually beneficial. It gives spare engine support for Air France-KLM's MRO operations. That's their maintenance division. And for AerCap, it means getting quicker MRO slots for their own fleet. That's critical for keeping planes in the air and earning.
Smoother operations, basically. And wasn't there something with helicopters, too?
Yes, a framework agreement with Leonardo for helicopter maintenance transitions. It shows they're, diversifying their strategic footprint beyond just fixed-wing aircraft.
So embedding themselves deeper in the whole aviation ecosystem?
Precisely. Securing future revenue streams,
Yeah.
optimizing how they operate. It adds another layer of resilience.
Okay, so big wins, strategic moves. Let's circle back to how the core business is actually performing day to day.
Right, because the leasing business itself continues to just shine. We mentioned the 99% utilization.
Almost unheard of.
And that 97% lease extension rate. But here's something else they highlighted. The rates on those extensions.
What about them?
On average, the new lease rates were actually higher than the previous leases, even on older aircraft.
Higher rates on older planes. Wow. What does that tell you?
It screams robust global demand, especially for wide-body aircraft. But it also points to a really tight supply situation.
The OEM production issues we keep hearing about?
Exactly. Management noted that out of their whole fleet of over 250 wide bodies, they only have 2 available for lease between now and the end of 2027.
Only 2. Until the end of 2027.
That's what they said. So think about it.
Yeah.
While airlines are struggling to get new planes from Boeing and Airbus,
AerCap basically has what everyone needs, and there isn't much of it available.
right, you give them significant pricing power. It's a massive advantage in this kind of market.
Okay, that makes sense. And what about capital allocation? They seem active there, too.
Very active. They've deployed over $1 billion in share buybacks just this year so far.
How much in Q2?
In Q2 alone, they repurchased 4.7 million shares for $445 million.
Okay.
Plus, they bought about $3 billion in new equipment in the first half, and they expect another $3 billion in new kit for the second half.
So buying back shares and investing heavily in new assets.
Yes. And they still have $800 million left on their current share repurchase authorization. So room to do more there, too.
Seems like a balanced approach. But there was one expense line that jumped out, wasn't there? SG&A.
Yes. Selling, general, and administrative expenses. They were up 37% year over year, hit $171 million.
That sounds like a lot. What drove that?
It was mainly higher share-based compensation. Seems like there was some upfront recognition timing involved.
So not necessarily a permanent increase in costs?
Management was pretty clear on that. They expect it to normalize back down to around $30 million per quarter going forward.
Okay, so maybe a point of scrutiny for analysts on the call, but positions is temporary.
Right. It likely impacted the sort of earnings quality perception for this specific quarter. But the message was, don't bake this higher run rate into your models.
Which brings us back to the million-dollar question, really. Why the heck did the stock dip if the core results, the guidance, the operations, they all look so strong?
Yeah, it's the core puzzle. I think it's likely a mix of things, focusing on the short term.
Like what?
Like that slight revenue miss we mentioned. And the higher SG&A, even if temporary, it probably raised an eyebrow for some.
Okay.
Then you have the broader background noise, ongoing uncertainty about potential macro tariffs, trade issues, and of course those persistent OEM supply shortages. While good for AerCap's existing fleet pricing, it can impact the pipeline for new sale-leaseback deals. Some caution probably stemmed from those areas.
Did management address those concerns directly, the tariffs, the OEM issues?
He did. On tariffs, they said the impact so far has been very limited, and they strongly advocate for a zero-for-zero tariff regime globally.
Pointing to some positive signs.
Yeah, they cited recent positive announcements between the U.S. and U.K. and the U.S. and EU as steps in the right direction. Removing uncertainty there would obviously be good for them.
And the OEM supply issues.
They indicated that dynamic might be starting to shift a bit. They're seeing more deals present themselves, which could suggest maybe, just maybe, an easing of that bottleneck eventually. A positive sign for future growth if it pans out.
They also weighed in on the engine versus airframe leasing debate. What was their take?
Yeah, that was interesting. They clarified that while engines, just the engine itself, might have a lower initial lease yield compared to a whole plane.
Because there's less to it, basically.
Right. No seats, galleys, etc. But they argued engines tend to have a shallower depreciation curve over the long run.
So they hold value better over time.
Potentially, yes. But their main point was neither is inherently better. The key, they stressed, is buying the right asset, whether it's an engine or an airframe, for its remaining economic life and, crucially, at the right price.
And they feel they have a good track record there.
They pointed to over 2 decades of doing just that. It's about judgment and managing a diverse portfolio effectively.
And on capital allocation, going back to the buybacks and M&A, they sounded extremely disciplined.
Oh, absolutely. Ruthlessly disciplined, you might say. They made it clear they'll use the existing $800 million buyback authorization first.
No rush to announce a bigger one.
Nope. And they were emphatic. They won't chase wide-body backlog growth or pursue M&A unless the returns meet their hurdles for shareholders.
And they had that great line.
The cheapest wide bodies are often found buying their own shares on the New York Stock Exchange.
Which tells you exactly how they view their own stock price versus the cost of new planes right now.
It really does. It signals immense confidence in their intrinsic value and a laser focus on shareholder returns over just, empire building.
So looking ahead then, what are the key catalysts for AerCap? What should you be watching?
Well, definitely the execution of that Air France-KLM engine JV. That's a big strategic piece. Then there's the potential for more insurance proceeds or other ways to monetize those recovered Russian assets beyond what they've already booked.
Right, that might not be fully done.
Could be more to come. And then just the broader macro picture. Improving travel demand helps everyone. But their specific advantage, that tiny pipeline of available wide bodies until 2027.
That scarcity factor again.
Exactly. And they expect their net spread, the difference between lease income and funding costs, to actually expand in the coming quarters and years as portfolio yields keep climbing.
So they think profitability still has room to grow.
That was the clear message. They don't believe the industry has hit peak profitability yet, which is a pretty bullish statement.
Okay, perfect setup for our This Is Not Financial Advice segment. Remember, folks, this is just us brainstorming an outrageous but plausible trade idea based on the deep dive, purely for fun and thought provocation.
All right, so given everything we've discussed, AerCap's underlying strength seems pretty clear, right?
Sure.
Record GAAP earnings, albeit helped by the recovery.
Raised guidance.
Tight supply dynamics working in their favor, disciplined management. That initial negative market reaction just looks, well, overdone.
The slight revenue miss, the temporary SG&A bump, maybe short-term noise.
That's the thesis. The market focused on the small negatives and maybe missed the bigger positive picture and the long-term strength.
Okay, so my audacious pitch for you today is go long AER. Simple enough. But here's the outrageous twist. Potentially pair that long AER position with a short position on an airline that's lagging behind. One that isn't actively renewing its fleet, isn't leveraging sale-leasebacks effectively, maybe struggling with older, less efficient planes.
So betting on the facilitator AerCap and against a struggling operator.
Exactly. The core idea is AerCap, with its smart capital use and unique asset access in this tight market, is undervalued. Their own buybacks scream that. The bet is the market eventually wakes up, digests the one-offs, sees the core earnings power and strategic moat.
And the stock re-rates significantly higher.
Right, pushing back to all-time highs, maybe beyond.
Right.
While that hypothetical, less agile airline gets squeezed by rising fleet costs because they can't get the planes AerCap provides, it's a play on strategic discipline winning out over market myopia.
That is definitely bold and plausible. It frames the market's reaction as a potential opportunity for investors who can look past the immediate quarter's details to the fundamental strengths and strategic positioning. An interesting thought experiment for sure.
So as we wrap up this deep dive on AerCap's Q2, the picture really is one of impressive underlying strength, wouldn't you say?
I think so. A quarter with incredibly strong reported earnings, yes, helped by that recovery, but also backed by raised guidance.
And operationally, just best-in-class metrics. Plus, smart, long-term strategic moves in engines and helicopters.
Absolutely. And despite that initial market hesitation we dissected, management's message was one of extreme discipline in capital allocation, focus on shareholder returns, and confidence. They're using their strong balance sheets smartly in a market where supply is tight and demand is recovering.
And that key message. They don't think the peak is here yet for industry profitability.
Which is a powerful signal for anyone watching this space.
Now remember, everything we shared today is for your education and understanding. It is absolutely not financial advice.
Please, always do your own research. Think about what stood out to you from this discussion.
We hope this analysis gave you some valuable insights into AerCap's latest call. Thanks for joining us on Talk Tickers.
And we look forward to our next deep dive with you.